Is everybody there from the break?
Yeah, everyone's here.
Maybe Kasun, if you can share your screen or try to see if you can share your presentations.
Yeah. Let me share the screen. Hope you can see it.
Yeah, that's perfect.
Okay.
Let's wait 1 more minute in case somebody else wants to join. Okay, so I think we can start. So welcome everybody to the last session. It has been a really great conference, and I'm really glad I have the opportunity to chair this last session. So as you know, we have 20 minutes for the presentation, 5 minutes for discussion, and 5 minutes for questions. We are going to start with our first presenter, Kasun Perera. The floor is yours.
Okay, right. Thank you, Marin. Very good evening to all of you. Today, I'll be presenting our research work on idiosyncratic volatility and carbon performance evidence from the US S&P 500 firms. I'm Kasun Perera, and the co-authors of this study are Gominda Guruparachi, Shrakumar Singh, and Kahal Suleiman. So this is the outline of today's presentation. And with that, let me move on to the introduction. First of all, the motivation, the reason as to why we selected this topic. As we all know, climate finance has grabbed the attention of lots of people across the world, and it has grown substantially over the last couple of years. And more importantly, carbon risk, one of the significant climate-related risks, is in the spotlight of contemporary finance literature. And these cited papers are some of the prominent work in this field, where they have focused on investigating various different finance and investment decisions, including stock returns, cost of capital, and market value of firms. Then again, we can also observe growing demand in terms of among the investors in terms of sustainable investing, also SRI, social responsible investing, over the last couple of years. The graph shows how it has grown over the years. Therefore, in order to be compatible with these unprecedented changes in the market conditions, firms have also adopted different various mechanisms to internalize the carbon pricing processes. So these graphs demonstrate how they have adopted these mechanisms, particularly during the last couple of years. Therefore, unlike in the past, nowadays managers are motivated to disclose firm level carbon information, mainly because of mainly with the rising ethical investing practices. And on top of that, social responsible investors gain more utility over financial returns attached to the assets. And this is a clear violation of one of the classical assumptions in asset pricing models, that is complete elimination or complete diversification of idiosyncratic volatility. Therefore, it is pretty much important to understand as to how the decision to disclose carbon information and carbon performance affect the idiosyncratic volatility of firms, given that there are substantial discrepancies among firms when it comes to carbon performance levels and disclosure of corporate carbon emissions. Therefore, the purpose of our study is to fill this important lacuna in the existing literature. And to serve our purpose, we have developed two research questions. Basically, the first one is about whether the decision to disclose carbon information reduce the idiosyncratic volatility of S&P 500 firms. Secondly, we'll be looking at whether the corporate carbon performance affects the idiosyncratic volatility of S&P 500 firms. Then if I talk a little bit about the contribution or significance of our study. So basically, as per the best of our knowledge, this is the first comprehensive attempt to study the impact of corporate carbon disclosure and carbon performance on the idiosyncratic volatility of firms. So meticulously, our contribution to the climate finance literature comes from with the findings on the impact of carbon emissions disclosures on the idiosyncratic volatility, where we compare this impact on both aspects, that means disclosed and non-disclosed firms. And these findings are pretty much important management, particularly in terms of reducing firm level risk. Then again, our findings contribute or our findings provide some interesting results that will contribute in terms of the corporate carbon performance on the idiosyncratic volatility, particularly by looking at competing theories. And these findings will be beneficial for both shareholders and managers, particularly in terms of reducing any potential conflict of interest between these two parties over initiatives to improve the carbon performance at firm level. Then having said that, let me now quickly move on to the literature review and hypothesis development section. Here we have developed two research hypotheses in order to address the two research questions which I showed you earlier. So in the first research hypothesis, we try to hypothesize a relationship between carbon disclosures and idiosyncratic volatility. So when we look at the empirical results, empirical literature, we can find that when firms make more disclosures on their performance, on their activities, they can reduce the firm level risk, basically because such disclosures will reduce the information asymmetries among market participants. So particularly the empirical literature shows that when firms make environmental disclosures, that will reduce the idiosyncratic volatility of firms. Then from theoretical perspective, we can look into the stakeholder theory, where it also argues in the same line, where it predicts that when firms make more disclosures, they can reach out to a wider audience so that they can fulfill different stakeholder needs. So that will enable firms to build a strong relationship with different stakeholders, and thereby they can the firms can reduce the firm level risk or the idiosyncratic volatility. Therefore, in light of these facts, we argue that the decision to disclose carbon information reduces the information asymmetries among the market participants. Therefore, we deduce our first hypothesis. As you can see, the decision to disclose corporate carbon emissions lowers the idiosyncratic volatility of S&P 500 firms. Then if I move on to the second hypothesis, there we try to create a link between carbon performance and idiosyncratic volatility. So in particular, when we look at ethical investing theory, it argues that polluting firms, they are exposed to high idiosyncratic volatility mainly because of the ethical exclusionary investing effect. That means investors try to move away from such firms so that these polluting firms, they face a reduction in their shareholder base so that they will lose the diversification ability, and thereby the overall the firm level risk will increase, so the idiosyncratic volatility increase. Therefore, this strand of literature argues that there is a kind of a positive, rather negative relationship between carbon performance and idiosyncratic volatility. That means higher the performance, lower the idiosyncratic volatility. However, another strand of literature argues completely opposite of this. That means particularly the managerial opportunism theory, where it argues that these initiatives to improve social performance of firms are undertaken for the benefit of the managers rather than for the benefit of the shareholders. So that misalignment of objectives between these two parties increases the agency related issues and thereby increases the firm level risk or the idiosyncratic volatility. So that this strand of literature expects or predicts a kind of a positive relationship between carbon performance and idiosyncratic volatility. So in light of these arguments, we hypothesize, since the existing literature supports both directions, so our second hypothesis we try to develop on a non-directional basis, and as you can see, we deduce our second hypothesis as corporate carbon performance affects the idiosyncratic volatility of S&P 500 firms. With that, let me now move on to the research design section. The data and sample. So our sample is based on US S&P 500 firms, and our sampling period is 2009 to 2018. And we used the GICS classification for industry categorization. And after filtering for missing data and the finance companies, our final data set comprises 3,824 firm year observations. And then this particular slide shows you as to why they selected S&P 500 firms. So they are among the top carbon emitters in the world, and also they own assets across the countries in the globe. And on top of that, there are the CSR activities and their disclosures are considered to be pretty much transparent and visible to a wider set of stakeholders, so compared to non-S&P firms. So those are the reasons for us to move ahead with this sample. Then if I move on to the estimation processes, the idiosyncratic volatility. So we follow Ang et al. 2006 method, and we used the Fama-French 3-factor model. And we also used Fama-French 5-factor model as a robustness check to validate our results. Then when it comes to carbon performance and firm characteristics, so we use emissions intensity ratio as a proxy for carbon performance, and rest of the firm level characteristics calculated or estimated based on the prior literature. And finally, the estimation models. So here we have used 2 estimation models. That means for the first hypothesis, we use propensity score matching. And for the second hypothesis, we use the Heckman two-step correction model, because our sample is prone to some selection bias because of the carbon disclosure choice of firms. So to address that, we use Heckman two-step correction. So these are the estimation models that we have developed. So with that, let me now discuss the empirical results with you. First of all, the descriptive statistics or the summary statistics. So as you can see in the highlighted area, the disclosed and non-disclosed firms. So you can see basically the I-wall is also significant difference between these 2 groups and the rest of the other variables as well. And these are pretty much inconsistent with the prior literature. So this resource triggers the importance of testing our first hypothesis. Then if I move on to the next slide, the correlation metrics. So based on the results, we can find that it is evident that there is no potential multicollinearity issue in our study. Then next slide is about disclosure of carbon information and carbon performance, and it provides some interesting evidence with respect to these aspects. So if you look at the panel A there, you can see during the sample period, EIR has monotonically reduced, or carbon performance has improved over the time. But when you look at the average actual carbon emissions during the same sample period, yes, it has dropped, but it is not as significant as the improvement in EIR. So it means, it suggests that firms are pretty much focused on improving their internal performance rather than focusing on reducing their actual carbon emissions. So that is pretty much in line with the prior literature, so prior findings as well. Then if you look at the panel B, there you can see the firms in high carbon intense industries, their average carbon emissions are more than 7 times higher to that of the firms in low carbon industries. And more importantly, if you look at panel C, we can see that the firms in high carbon intensive industries, they tend to make high level of disclosures on their carbon emissions compared to firms in low carbon intensive industries. So this is again in line with particularly the arguments put forth by Clarkson et al. 2008, where they argue that polluting firms, they tend to make more disclosures on their carbon emissions because they face a legitimacy problem in terms of their business operations. So they use these disclosures to legitimize their activities. So our findings also provide direct support to these arguments. Then if I move on to the next slide, where this is where we first test our first hypothesis. So we use propensity score matching, and we use nearest neighbor matching algorithm to make a matching between these two groups. That means the non-disclosed and disclosed group. So you can see in the highlighted area, the average idiosyncratic volatility of disclosed firms is approximately 1.23% lower to that of the non-disclosed firms. That means suggesting that disclosure of carbon information reduces the idiosyncratic volatility of firms, and it clearly supports our first hypothesis, or our first hypothesis accepted. Then, if I move on to the next slide, there we try to test our second hypothesis using the Heckman two-step correction model. As you can see in the highlighted area, EIR, it is negative and statistically significant for all three estimations: pooled OLS, fixed effects, and random effects. And here EIR is negative related with the carbon, rather idiosyncratic volatility. So lower EIR means poor performance, poor carbon performance. So our research suggests a kind of a positive relationship between carbon performance and idiosyncratic volatility. So it is pretty much in line with the arguments put forth in managerial opportunism theory. So our research suggests that there is a potential conflict of interest between shareholders and managers over the managerial initiatives to reduce carbon emissions at firm level. Then again, if you look at IMR, the inverse Mills ratio, it is also significant, and it means that there is a significant difference between disclosed group and non-disclosed group in terms of the idiosyncratic volatility. So that is what we have already identified in our first hypothesis. So it reconfirms our results. So then again, we can say that our H2, or the second hypothesis, also accepted in terms, that means the carbon performance affects the idiosyncratic volatility of firms. So with that, let me now move on to the robustness checks that we have conducted to validate our results. There, first we try to use an alternative asset pricing model to estimate IVOL. As I said earlier, we use a Fama-French 5-factor model, and we reran we retested the two hypotheses that we developed. So the results are pretty much similar to what we have observed earlier, and as you can see in the first hypothesis, its results are robust and pretty much in line with what we have observed earlier. Then again, if you look at the next slide, again, we used the Fama-French 5-factor model estimated IVOL to test the H2 results, H2 hypothesis. So results are again pretty much similar to what we have observed earlier. So all in all, our findings provide kind of statistically significant and robust results in terms of the two research hypotheses that we developed. So finally, in conclusion, sorry, I missed this slide as well. So there is another estimation that we have used to check the robustness of our results. That means that we used an estimation for EIR, where so far we used the total cells to scale the total carbon emissions. And here we use total assets instead. So results are pretty much similar to what we have observed earlier. So in conclusion, our empirical findings do support the two research hypotheses that we developed, and we also found that the firms in high carbon intensive industries, they tend to make a high level of disclosures on the carbon emissions, which opens up another avenue for us to further look into this topic. That means in terms of the effects of carbon emissions on idiosyncratic volatility, whether that relationship is particularly concentrated in one particular industry or not, whether it is limited to high carbon intensive industries or not. So it's a kind of a area for us to further look into. And with those concluding remarks, and I will wrap up my presentation. Thank you very much.
Thank you so much, Kasun, for your presentation.